Hello and welcome to this module on the decentralized finance class. So in the last module, we kind of covered high level what DeFi is and why it's an interesting proposition for the worldwide economy. But in this module, we're going to turn a little bit inward. We're going to look at the different categories of decentralized finance, how people are building it out, and more importantly, how you can utilize decentralized finance for profit. So again, decentralized finance is a movement that leverages open source software and decentralized networks to transform or replace traditional financial products into trustless and transparent protocols that operate without unnecessary intermediaries. One could envision decentralized finance impacting the financial world the same way that open source software has changed software products. So I know in the last module we talked about decentralized finance as being an extension of cryptocurrency. It embodies the same ideals, but it's more practical. It bridges the gap between traditional finance and the cryptocurrency space. And in doing so, it finds applications, different categories where we find utility by using decentralized finance. Chiefly, when I look at decentralized finance, and what we're going to explore in a lot of this class, are 10 major categories of application. Those 10 categories are decentralized exchange protocols, stablecoins, lending protocols, derivative protocols or prediction markets, bundling protocols, tokenization protocols, fund protocols, KYC AML identity solutions, applications or tools, and analytics, as well as a sort of grab bag miscellaneous category. You may have heard of some of these categories, especially in the context of cryptocurrency, but I argue that this is the basis, the foundation of what decentralized finance represents. You should notice that many of the categories that comprise decentralized finance are based off of protocols. Many of those projects, those protocols, do not use cryptocurrencies, a utility token, or instead they build off an existing decentralized network, platform like Ethereum, etc. This should also give you somewhat of an idea as to where we're going to target opportunities for profit as well. Looking at things like lending protocols, derivative protocols, bundling and tokenization. These are hot button, very potentially lucrative categories that we definitely want to look at and see where we could derive profit from. But this is not to discredit the role that something like a KYC AML identity solution will play. So while there's definitely opportunity for profit, we also have the ability to speculate on the role, the application of some of these auxiliary services. So you can see there's a lot of breadth and depth to DeFi. And mind you, this is still an industry in a nascent stage. Many more sectors, categories will be built out over time. So really, this is just scratching the surface, the tip of the iceberg. But where I think we're going to find some value is to go through each of these categories, identify opportunities, identify what they're doing and how they're doing it. And together we'll have a better understanding of how to approach this opportunity, where we should be looking at, and more importantly, how things are going to grow and change over time. So let's dig right into it. Starting right off, we have decentralized exchange protocols. You might have heard of these in conjunction with their role as playing the antithesis of centralized exchanges. Centralized exchanges are what you're probably familiar with. You can buy and sell and trade cryptocurrency pretty freely. But the thing to note about centralized exchanges is that you don't actually own the cryptocurrency that you're buying and selling and trading. This is because the centralized exchange will not let you have access to the private key of the wallets on your account. They give you the public key so you can send or deposit your cryptocurrency into and out of your account, but the private key is what gives you true control of your account. In order to access true control of your cryptocurrency through the private key, you would need to send your cryptocurrency off an exchange into a wallet that you can control, and by extension, you would have access to the private key in that case. The problem is that for most people, they don't want to be accessing the private key. They don't want to be managing that level of control, because with that level of control, it also opens up a lot of risk. What if you lose the private key? What if you forget your encryption password? What if your hard drive crashes or anything like that? Thankfully, solutions like hardware wallets have come along that give you the control of having the private key without actually having to see it and manage it. All you need to remember is a 4-digit PIN code and to keep the seed phrase separate from the actual hardware wallet itself. Using a hardware wallet like a Ledger Nano S, or even using an online wallet like MetaMask, you're able to control and lock down the security of your crypto by orders of magnitude more than if you were just to copy and paste your private key. In turn, this has also given rise to decentralized exchanges. As people have realized that centralized exchanges are quite fallible, you are literally entrusting this exchange to protect your cryptocurrency investment. And if they get hacked, well, you are unfortunately out of luck. But if you control the wallet, if you control the private key, if you use a security device like a hardware wallet, this gives you a much better fighting chance of not having something like that happen to you. But the chief problem always with wallets is that if you take your cryptocurrency offline, if you try to bury it essentially, what happens if you want to access it really quickly, trade it, move it around, send it? And furthermore, you have to send it to a centralized exchange and take the risk of having your cryptocurrency on a platform that is inherently not decentralized. It's the great irony of cryptocurrency is that we have a decentralized asset that is trading on a centralized exchange. So decentralized exchanges aim to solve this by allowing you to trade from a wallet that you can control. In theory, you get all the benefits of a centralized exchange where you have the ability to trade and manage your cryptocurrency with having a wallet that you can control. So you get security and knowledge that even if the decentralized exchange went down, well, you still control your cryptocurrency, you can still move it around. If a website like Binance went offline, there's no way for you to access your cryptocurrency wallet if the website is down. So lately, there's been a lot of noise about decentralized exchanges and their eventual role in the cryptocurrency or decentralized finance industry. The principal problem with decentralized exchanges is that unfortunately, they're hard to use. It's not an easy process. And for example, if you wanted to use IDEX, one of the most popular Ethereum decentralized exchanges, in conjunction with your Ledger Nano S, you have to sign every transaction that occurs on that exchange. So for example, if you wanted to buy some cryptocurrency, well, you have to sign it on the ledger. If you wanted to sell, you have to sign it again. And no, this is not exactly hard to do, but it definitely takes away from that snap trading mindset that you get on a centralized exchange where things are moving really fast. Decentralized exchanges, unfortunately, don't have the liquidity that centralized exchanges have. Eventually, we'll see some shared liquidity protocols and some hybrid solutions of blending centralized and decentralized exchanges try to mitigate this. But for now, the industry stands as pretty separate in terms of centralized versus decentralized exchanges. So in summary, I do think that there's a role to play for decentralized exchanges. That role is still being built and built out, but it's important to note that they are a core tenet of where crypto is going and what DeFi represents. I mean, think about what at its core a decentralized exchange is. It's giving you the freedom that is inherent with owning your own wallet, essentially being your own bank, and it's giving you an interface to interact with other people who are doing the exact same thing. So while the early iterations are a little bit clunky, the promise, the potential of a global trading network of people that own and manage their own assets, well, that's pretty interesting and that's pretty special. And it's one of these conventions that DeFi, decentralized finance, and decentralized exchanges are helping to shape the narrative on. So while I don't believe that decentralized exchanges will be this amazing way to make money right away, I do think that they stand as a core element of the DeFi space, and they help to prop up a lot of the other categories that we're talking about. Some examples of decentralized exchange protocols are BitShares, 0x, Bancor, Kyber, Loopring, Ren, Uniswap, StellarX, and Hydra Protocol. Obviously, the decentralized exchange space is moving pretty fast, so it's hard to get a sense of where we'll have decentralized exchanges be even a year from now. But I think they have a very important role to play. Similar in charter are stablecoins. Stablecoins are another example of a core layer of decentralized finance that, while not very significant or flashy on their own, give us something to stand upon, give us something to work from in order to build out our grander vision. I can think of no better example of building the bridge between legacy finance and cryptocurrency than stablecoins. In many ways, they serve as the gateway for moving institutions and many players of the legacy financial system into a more decentralized economy. into the tenets of decentralized finance. The topic of stablecoins has been generating a lot of interest recently. What is clear to me is that stablecoins aim to be a part of an asset-backed digital token ecosystem and part of the decentralized financial future. In general, there are three types of stablecoins. The first is IOU, or centralized or fully backed, and this is the type of stablecoin that you might be most familiar with. For example, this is what Tether is, or True USD, or Gemini Dollar, Paxos, USDC, etc. They're generally going to be ERC20 stablecoins issued by a company, and the basic premise is that when we say it is centralized or fully backed, we mean that for every Tether or USDC or Gemini Dollar, etc., we have a one-to-one reserve for that stablecoin. In this way, it's meant to prevent any price fluctuation and anything else that would compromise the stable nature of these stable coins. And so the next category of stablecoin is collateralized. The best example of a collateralized stablecoin is DAI, which is part of the Maker ecosystem. DAI is a stablecoin based on smart contracts for creating collateralized debt positions. What this means is that instead of having a very large bank account sitting with a one-to-one peg of every DAI stablecoin issued, instead DAI is based on collateralized debt, be that other cryptocurrencies, or eventually you could have different fiat currencies, you could have real estate collateralized, you could have precious metals collateralized, and really the goal is to have a system that is self-correcting. That's why DAI is part of a dual token system with Maker, and how it aims to basically balance the scales to make sure that DAI retains its one-to-one peg with the US dollar. I think DAI and Maker are some of the best examples of a true DeFi project that is looking to innovate and expand upon something that isn't necessarily very exciting or flashy by itself, but is a critical piece of infrastructure for the overall industry. If we could have a multi-collateralized stablecoin that is provably solvent and able to retain its dollar peg, well, that's very groundbreaking and will help prove to people that DeFi is legitimate, that the decentralized economy, decentralized finance really does aim to be an alternative system to the legacy centralized systems. There's a lot more to talk about and explore regarding stablecoins like DAI, and there's a lot more to talk about regarding projects like Maker and how they aim to expand and build upon the DeFi ethos, but I think it's pertinent that we move along. The last type of stablecoin is algorithmic, and this is the type of stablecoin that is a little bit more experimental, kind of a grab bag of different types of financial engineering. For example, you have Terra, which is a protocol that ensures price stability by algorithmically expanding and contracting supply. You've got Carbon, which is a stablecoin that will be comprised of a basket of white label tokens that is functionally fiat backed with the potential to whitelist an algorithmic stablecoin. And you've got Ampleforth, which is a monetary policy based stablecoin protocol formerly known as Fragments. Look, I think there's some interesting ideas here, but it's clear to me that the algorithmic stablecoin is still a work in progress and a proof of concept, really, versus the more established, centralized, and collateralized stablecoins out there. So let's move into some of the more meaty topics of decentralized finance. Some of the categories of DeFi are going to be inherently more profit-driven, have more profit potential than others, and lending protocols is a great example of that. Much of what comprises lending protocols is peer-to-peer lending, tokenized debt, algorithmic money markets, margin trading, short selling, inherently a little bit more risky applications. But the payoff is that you're, for example, able to lend out your cryptocurrency and receive dividends off of it. With something like Compound, you're able to put up your stablecoin DAI and earn interest off of it. You can supply assets to Compound and earn interest, or borrow from Compound and pay interest. Each market has dynamic interest rates which float in real time as market conditions adjust. You also have something like Dharma, which is a platform for building lending products on Ethereum. Dharma Lever is one of those products, and it provides instant margin loans for traders. It facilitates peer-to-peer crypto lending by allowing two parties of a loan to be discoverable. You have the ability to borrow and lend crypto assets directly from your personal wallets. You can customize the desired loan terms, including asset type, collateral, and duration. Once you trustlessly lock up collateral in a smart contract, you receive principal instantly. Finally, as a lender, you set a risk profile by specifying the desired loan terms. What's interesting is that both Compound and Dharma are examples of protocols that don't have tokens. As I mentioned earlier, this is becoming a staple of DeFi, and what really sets it apart from the cryptocurrency industry itself is that many of these protocol layers, these platforms, are being built off of Ethereum, but don't utilize their own token. This allows you to focus on what they're doing rather than how they've shoehorned in some utility token that has barely any utility, if at all. Other examples of lending protocols include Ethelend, Lendroid, Marble, and Ripio. Another great example of what DeFi can build are derivative protocols or prediction markets. Again, this is another category where Ethereum just absolutely shines in terms of what it's able to be facilitating, what is able to be built upon it. You have prediction markets like Augur and Gnosis. You've got examples like DYDX, which is a margin trading and options protocol. You've even got examples like Veil, which is a peer-to-peer prediction market and derivatives platform built on top of Augur, 0x, and Ethereum. This category definitely represents a wild card in terms of potential, risk, and just sheer absurdity and potential that DeFi represents. The ability to facilitate a prediction market like Augur, for example, where you can bet on literally anything, or to use the bundling protocols, which we'll cover in a sec, to create a set of real estate and then to build derivatives off of that using DYDX. This is the vision I've had of the decentralized financial future, taking real assets, real events, and building a decentralized financial network around them. This is what DeFi represents. This is what derivative protocols and prediction markets will facilitate. So needless to say, I'm interested, cautious even, of what derivatives and prediction markets will do. But at the same time, I recognize the potential here. And I very much look forward to what the next couple of years look like for this category, because I really do think it's going to be quite mind-blowing what people come up with. Coming back to earth a little bit and moving into the next category, we have bundling protocols. This is where you see things like Basket Protocol and Set. And really, these are protocols for creating, issuing, redeeming, and rebalancing fungible collateralized baskets of tokenized assets. That can be cryptocurrency, that can be real estate. It allows you to build mini ETFs, mini baskets of these assets that you can trade, that you can speculate on, that you can build derivatives off of. And yeah, there's not much I can really do to try to sell how interesting bundling of assets can be. But hopefully this is another example of where DeFi's potential really shines and works in concert with some of the work being done on tokenization. For you to be able to tokenize a large amount of real estate, bundle it together with something like Set Protocol, and then build derivatives off of that using DYDX, that's an interesting proposition. That's something I foresee as being part of the decentralized financial future. This is also where you would see the next category, fund protocols, being utilized for digital asset management. Project like Melonport is a great example of this, and something we'll dive into later. Additionally, tokenization protocols, commonly referred to as STOs or security tokens, are really a rising star of the overall cryptocurrency industry. While I feel it's necessary and beneficial to look at STOs and the STO industry as its own separate industry, it should be noted and commented on that a lot of what is enabling, building out, and growing the STO industry is the core tenets and protocols of DeFi. Looking at the world, seeing the centralized systems, and imagining how a decentralized financial system could be built out of it or on top of it. That's inherently a core vision that motivates both DeFi and STOs. And it's why I refer to them as the bridges between the legacy financial system and cryptocurrency. DeFi and STOs will be what helps move institutions and players from the legacy financial system into the more decentralized financial future. It's going to be projects like Harbor, Polymath, Securitize, T0, and many other projects in the STO space that are pushing this forward. Quite obviously, there's a lot we can cover with tokenization, so In the interest of not being pedantic and saving that topic for a later point in the class, I'll move along to KYC and AML. This is another topic that I feel really represents the potential and the need for DeFi. We live in a world that is going to be increasingly focused on digital identity. That in turn plays right into the hand of decentralized finance and the decentralized financial future. Projects like Bloom, Hydro, Selfkey, Wire, and Civic are all working in different ways to have a system to handle digital identity, especially in a decentralized world, seeing how we can integrate an identity management system with various financial services, especially the decentralized kind. That's another example of one of these core protocol layers that doesn't sound very exciting on the surface level, but is really critical to establishing this decentralized financial system. Without proper KYC AML checks in place, we simply won't have a functional bridge between the legacy financial system and the decentralized one. Yes, some in the cryptocurrency space lament that, but it's the unfortunate nature of the world we live in and how things are going to be moving forward. So I'd rather this industry tackle it head on and make it an emphasis than trying to fly in the face of compliance and regulation. This goes hand in hand with the tokenization category, for example, and how we're looking to build a decentralized financial future while also not usurping the role that governments and investor protection agencies must play. And so the last two categories, applications, tools, and analytics, as well as the miscellaneous category, all can more or less be lumped together and looked at as important auxiliary services that make this whole financial system work. You know, it wouldn't be without people building things like explorers, dashboards for DeFi activities, analytics suites, and other developer tools that we couldn't have this entire DeFi ecosystem. So it's definitely important to note and make mention of these auxiliary categories, even if they're not directly relevant to our purposes as investors. So that was high level what decentralized finance, the DeFi space, represents in terms of its different facets, the different ways that we're going to be looking at how to identify opportunities, where we need to be looking at, and how we should be moving forward. Hopefully it's also clear at this point that DeFi does represent a separate and powerful entity that isn't looking to replace or conquer cryptocurrency. It's building upon it. If anything, it is giving blockchain and decentralization much needed credibility and applications that we were severely lacking in the early days of the cryptocurrency industry. DeFi represents how the crypto industry is going to move forward, and hopefully you're as excited as I am about the future of this industry and each of the micro categories that comprise it. So in the next module, we'll start to look into each of these different categories. We'll start to look at individual projects, and we'll start to give you the tools that you need to really conquer this space and get in front of it. So look forward to that, and I'll see you in the next module.